what I believe, and you've heard me say this a number of times, and I'm going to say it again, and I'm going to say it with an exclamation point, is, in my opinion, it's the oil prices that are going to be the biggest determining factor on what happens with interest rates, mortgage interest rates specifically. Now, we can talk about, Fed rate cuts. We all know that's short-term rates, not long-term rates. We can talk about CPI and PCE and core PCE and Fed's favorite, thing to look at and all that stuff. We can talk about employment numbers. And yeah, of course, all of those things are important, some more important than others. I would argue inflation and jobs are going to be the most important thing to understand what the Fed's going to do. But as far as mortgage interest rates go, I've seen a lot of charts on how it is that rates move. And the one thing that is crystal clear to me is if the price of oil, if the price of a barrel of oil goes down, so do mortgage rates. And if it goes up, so do mortgage rates. And the two are very closely associated. So whenever I'm looking at any problem, any I'm trying to solution for something, I look at what are the big things? What are the big rocks that we need to identify? And in me, this one's simple. If oil prices cut in half, which I think that's what Trump said, we're going to cut the price of oil in half. Okay. Well, I don't know how the oil companies are going to feel about that. That's a whole nother conversation. But if, let's just say that happened, you guys, mortgage rates are going to go down. Inflation is going to go down. That's just going to happen. And so anyway, I think it's interesting, but that's my take. The thing I'm watching the closest is what do oil prices do? And I think that's going to be very telling. Now, as far as my prediction, I said on that conversation with Dan, I'm not going to necessarily predict what I think interest rates are going to do. I've done that in the past. And the reality is I have no clue. If I had something I could feel good about, then I would tell you that, and I'll take my lumps, and I have no problem putting myself out there and telling you why I think something is the way that it is. I think that we're going to see more of the same until we see a reason for something different. Okay. So I know that's not super clear, but I don't think rates go up drastically. I don't think they go down drastically, but I think they could, depending on what happens. I don't see a lot of situations where rates go up significantly. Could they trend up a little bit more? Could inflation, trend up a little bit more? Absolutely. Rates could get a little bit worse. They could maybe reach the highs that we've already seen over the last year and a half. But as far as how low they're going to go and how long they're going to stay there, that is very data dependent, and it really depends on, I think, what happens with the price of oil. If they can get, if that can drive down. Obviously, we could get lower rates with lower inflation and unemployment going up. Those things would obviously get us there quickly as well. So I don't have a lot of predictions there. Now, Dan Habib did say he could see rates reaching a level that the previous lows that we saw here recently. And that would put us somewhere just under 6%, like 5 7/8, let's say. Okay, so maybe we see a 5 7/8 interest rate, at some point here in 2025. Certainly not the fours. If you guys remember, I did a podcast where I showed that once the Fed starts cutting rates, at some point, in every other Fed rate cut cycle, the interest rate will meet or cross over the median outstanding interest rate of all mortgage debt, which we think that number is probably around 4.5 right now. Like, you look at all the outstanding mortgages and what the average rate is on those, which obviously is going up, right? Because more and more mortgages get added to that pool, that rate's going up. But let's say that number's in the 4.5, probably closer to 4.5 right now, 4 5/8. On its way up slowly because there's a lot of loans that are under 4%. And at some point, those two numbers are going to cross. Now, maybe that's in 2025. Maybe it's not until 2026. But it does tell me that rates at some point in this cycle will probably get into the low fives, possibly the high fours. But is it going to happen in 2025? I'm not going to bank on it. Let's put it that way. I'm not going to bank on it. Do I think it could happen? Sure. I think there could be lots of things that I could think of that could create this a black swan event just with what's going on in the world around us that could make that happen. But I'm not predicting it, and I'm not going to build my assumptions. I'm not going to build my business plan assuming that we're going to see interest rates get any better than they are right now. And I think that would be probably prudent for all of us to assume more of the same and then build our strategies around that. Now, the good news is that I think the average consumer is getting used to rates where they are. So at least we don't have this, freak out factor when you quote them a rate that they're shocked that rates are that high. I mean, this has been going on now for a few years. I think people are used to it. And now you're hearing from the Fed, this whole idea of higher for longer. It's definitely playing out. And I think that, we're in a place where people are used to, they don't like it, but they're used to rates being where they are. So that's my thought there.